What if someone told you that your biggest financial fear is actually costing you more money than your biggest financial mistake ever could? That sounds impossible, right? But here's the shocking reality. The fear of losing money through investing is keeping millions of people from building wealth. And this fear is literally more expensive than any market crash, any bad investment, or any financial disaster in history. Here's what nobody talks about in those how to invest videos. Fear isn't just an emotion that makes investing uncomfortable. It's a wealth-destroying force that's systematically keeping entire generations poor. And the worst part, the very thing people are afraid of, losing money, is guaranteed to happen if they don't invest, just in a different, more insidious way that they can't see happening. If you're new to our channel, don't forget to subscribe and hit that bell icon so you won't miss out on the valuable insights we share in our future videos. What we're about to reveal will completely reframe how you think about investment risk and show you why not investing is the riskiest financial decision you can make. Let's destroy the fears that are keeping you poor and show you how to start building wealth despite being scared. The real cost of investment paralysis. Let's start with something that will probably shock you. The safe choice of not investing is actually the most dangerous financial decision someone can make. While people worry about losing money in the stock market, inflation is silently destroying their purchasing power every single day, and they don't even realize it's happening. Here's the brutal math. If someone keeps $10,000 in a savings account earning 1% interest, while inflation runs at 3% annually, they're losing 2% of their purchasing power every year. That means their money can buy 2% less stuff each year, guaranteed. Over 20 years, that $10,000 will have the buying power of about $6,700 in today's money. They didn't lose money in a dramatic crash, it just slowly evaporated while they thought they were being safe. But here's where it gets really devastating. That same $10,000 invested in a broad market index fund historically would have grown to over $40,000 in 20 years, even accounting for inflation and including major market crashes. So the safe choice of avoiding the stock market didn't just cost them $4,000 in inflation losses, it cost them over $30,000 in missed gains. Studies show that people who delay investing for just 5 years need to save almost twice as much monthly to reach the same retirement goals as those who start earlier. The fear of market volatility causes people to miss out on the most powerful wealth-building tool in human history: compound growth over time. Here's what's particularly cruel about investment paralysis. The longer people wait to start investing, the more they need to risk to catch up. Someone who starts investing at 25 can build substantial wealth with conservative, diversified investments. Someone who waits until 45 might feel pressured to take big risks on individual stocks or speculative investments because they're running out of time for compound growth to work. The fear of losing money in investments causes people to make the one financial decision that guarantees they'll lose money, keeping everything in cash while inflation eats away at their purchasing power year after year. Understanding what you're really afraid of. Now let's talk about what people are actually afraid of when they say they're scared to invest. Because once you understand the specific fears, you can address them rationally instead of letting them control your financial decisions. The first fear is losing money permanently. People imagine putting money into the stock market and watching it disappear forever. But here's what the data shows. Over any 20-year period in stock market history, broad market investments have never lost money. Never. Even including the Great Depression, the dot-com crash, the 2008 financial crisis, and every other market disaster. Patient investors who stayed invested in diversified portfolios eventually recovered and went on to new highs. The second fear is bad timing, putting money in right before a crash. This fear keeps people on the sidelines waiting for the perfect time to invest. But research shows that even the worst possible timing doesn't matter much over long periods. If someone invested $10,000 at the peak of the market right before every major crash over the past 40 years, they would still have hundreds of thousands of dollars today because they stayed invested and kept adding money over time. The third fear is not understanding how investing works. People are afraid of what they don't understand and the financial industry has made investing seem more complicated than it needs to be. But here's the truth. Successful investing is actually incredibly simple. Buy diversified index funds regularly over long periods of time. That's it. No complicated strategies, no stock picking, no market timing required. The fourth fear is needing the money during a market downturn. This is actually a legitimate concern, but it's easily solved through proper planning. Money that someone needs within the next 5 years shouldn't be invested in stocks anyway. It should be in savings accounts or other safe, liquid investments. Only money that won't be needed for many years should be invested in growth assets like stocks. Here's what successful investors understand. These fears aren't irrational, but they're manageable through proper education, planning, and strategy. The goal isn't to eliminate fear. It's to invest despite being afraid, and to structure investments in ways that minimize legitimate risks. The psychology of investment fear. Let's dive deeper into why people are so afraid of investing, because understanding the psychology behind these fears is crucial for overcoming them. The human brain has several built-in biases that make investing feel much scarier than it actually is. First is loss aversion. People feel the pain of losing money about twice as strongly as the pleasure of gaining the same amount. This means that even when investments go up more often than they go down, the fear of losses feels more powerful than the excitement of gains. This psychological bias makes people overestimate the risks of investing while underestimating the risks of not investing. Second is the availability heuristic. People judge how likely something is based on how easily they can remember examples of it happening. Media coverage focuses heavily on market crashes and investment losses because dramatic negative events get more attention than steady positive growth. This makes market crashes seem much more common and severe than they actually are. Third is recency bias. People assume that recent events are more likely to happen again. If someone starts paying attention to investing right after a market crash, they assume crashes are normal and frequent. If they start paying attention during a bull market, they might assume markets always go up. Both perspectives are distorted by whatever happened most recently. Here's what's particularly interesting. People who lived through the Great Depression often remained afraid of stocks for their entire lives, even though the stock market delivered incredible returns for decades after 1932. Their early experience with market volatility shaped their entire relationship with investing, causing them to miss out on enormous wealth creation opportunities. Understanding these psychological biases helps explain why investment fear feels so intense and why logical arguments about long-term returns often don't overcome emotional resistance to investing. The fear isn't really about money. It's about ancient survival instincts that treated any potential loss as a threat to survival. Building your investment confidence step by step. Here's how to overcome investment fear through education, preparation, and gradual exposure. The goal isn't to become fearless. It's to become comfortable investing despite reasonable concerns about volatility and risk. Step 1. Educate yourself about how markets actually work. Read about market history, understand what causes volatility, and learn about different types of investments. Fear often comes from ignorance, and knowledge is the best antidote to investment anxiety. Understand that market volatility is normal and temporary, while long-term growth is historically consistent. Step 2. Start with tiny amounts. Instead of jumping in with large sums, start investing $25 or $50 per month in a broad market index fund. This lets people experience market ups and downs with money they can afford to lose while building comfort with the investment process. As confidence grows, they can gradually increase their investment amounts. Step 3. Automate everything possible. Set up automatic transfers from checking accounts to investment accounts and automatic purchases of index funds. This removes the emotional decision-making from investing and ensures consistent investing regardless of market conditions or personal anxiety levels. Step 4. Focus on time in the market, not timing the market. Instead of trying to find the perfect moment to invest, commit to investing consistently over long periods. Dollar cost averaging. Investing the same amount regularly, regardless of market conditions, helps smooth out volatility, and removes the pressure to make perfect timing decisions. Step 5. Prepare for volatility emotionally and financially. Expect that investments will go down sometimes. That's normal and healthy. Have an emergency fund in savings so you're never forced to sell investments during market downturns. Understand that temporary losses are the price of admission for long-term gains. Most importantly, reframe how you think about investment risk. The biggest risk isn't losing money in a market crash. It's not having enough money for retirement because you were too scared to invest during your working years. Creating your fear-proof investment strategy. Now let's build a specific investment approach that addresses common fears while maximizing long-term wealth-building potential. This strategy is designed for people who are afraid to invest, but understand they need to overcome that fear to build financial security. Start with a 3-bucket approach to money management. Bucket 1 is immediate expenses and emergency funds. Keep this in high-yield savings accounts. Bucket 2 is medium-term goals within the next 5 years. Keep this in conservative investments like bonds or CDs. Bucket 3 is long-term wealth building. Invest this aggressively in stock market index funds because you won't need this money for decades. For the long-term investment bucket, use broad market index funds rather than individual stocks. The S&P 500 Index Fund gives instant diversification across 500 large companies, reducing the risk of any single company destroying your portfolio. Total stock market index funds provide even broader diversification across thousands of companies of all sizes. Implement dollar cost averaging by investing the same amount every month, regardless of market conditions. This strategy automatically buys more shares when prices are low and fewer shares when prices are high, improving long-term returns while reducing the anxiety of trying to time purchases perfectly. Set up automatic rebalancing to maintain your target allocation between stocks and bonds. As you get older or as your risk tolerance changes, gradually shift more money toward conservative investments. But don't make dramatic changes based on short-term market movements or emotional reactions to volatility. Most importantly, commit to staying invested during market downturns. History shows that the investors who panic and sell during crashes lock in their losses and often miss the recovery. The investors who stay calm and keep investing during scary times are the ones who build substantial long-term wealth. Your action plan for starting despite fear. Here's exactly what to do if you're scared to invest, but know you need to start building wealth. First, open an investment account with a reputable broker that offers low-cost index funds. Companies like Fidelity, Vanguard, or Charles Schwab are excellent choices for beginners. Second, start small with an amount that won't cause financial stress if it temporarily goes down. Even $25 per month is enough to begin building investment experience and confidence. The goal isn't to get rich immediately. It's to start the wealth-building process and overcome psychological barriers. Third, choose simple, diversified investments like total stock market index funds or target date funds. Avoid individual stocks, sector funds, or complicated investment products until you have years of experience with basic investing. Fourth, automate your investments so you don't have to make emotional decisions each month. Set up automatic transfers and purchases so your investment plan continues regardless of market conditions or personal anxiety levels. Fifth, educate yourself continuously about investing principles, market history, and long-term wealth-building strategies. The more you understand about how investing actually works, the less scary it becomes. Most importantly, remember that everyone who has ever built wealth through investing was scared when they started. Fear is normal and rational. Markets are volatile and unpredictable in the short term. But letting fear prevent you from participating in long-term wealth creation is guaranteed to keep you financially insecure. The people who overcome investment fear and start building wealth aren't the ones who stop being afraid. They're the ones who invest despite being afraid. They understand that the risk of not investing is much greater than the risk of investing wisely over long periods. Your financial future depends not on eliminating fear, but on taking action despite reasonable fears. every month you wait is a month of compound growth you can never get back. Every year you delay is exponentially more expensive than any temporary market loss you might experience. If you found this video helpful in overcoming your investment fears, please give it a thumbs up and don't forget to subscribe to our channel. Hit that bell icon to make sure you don't miss any of our future videos where we'll continue to help you build wealth and financial confidence. Thank you so much for watching, and remember, the best time to start investing was 20 years ago, but the second best time is right now, even if you're scared. See you in the next video.